Good afternoon and welcome to our webinar. It's session 2 of our ACA series. This one is Failure to File and Furnish, an Anatomy of a Disaster. Today we are joined by Michelle Barki, Senior Legal Counsel and Director of our Compliance and HIPAA departments here at MedCom Benefit Solutions. My name is Casey Hope and I'm the Director of Marketing and Communications, and I'm so glad that you were able to join us today. We certainly appreciate your time and commitment to MedCom Benefit Solutions. And we want to let you know that this webinar is being recorded. We will be able to provide you with the slide deck and recording after the webinar concludes today. And as well, we will have a Q&A session at the end. If anything that Michelle discusses today sparks a question, feel free to put that in the questions panel, and we will address that at the very end of the webinar. So today we're going to be talking about a few things, but I'm going to go ahead and turn it over to the expert in-house, Michelle Barki. Michelle?
Thank you, Casey. And today we're going to talk about where the IRS is with the penalty notices and letters, and they're becoming a lot stricter than they were before. We're going to talk about Section 6055 and Section 6056. And these are the failure to file and the failure to furnish. And then we're going to be talking about reasonable cause. So the IRS does have a mission statement. And the mission statement is to provide American taxpayers top quality services by helping them understand and meet their tax responsibilities and enforce the law with integrity and fairness to all. So it's not a very forgiving statement. It basically says they will enforce the rules. And then they go on to say, in the United States, Congress passes the tax laws, and Congress requires taxpayers to comply. The taxpayers' role, as they said in their mission statement, is to understand and meet their tax obligations. And the IRS role is to help most compliant taxpayers with tax law while ensuring that the minority who are unwilling to comply pay their fair share. So let's talk about the broker's role. If the taxpayer's role is to understand their tax obligations, how do the brokers help them understand their tax obligations, and especially when it comes to the Affordable Care Act? You guys play a very, very important role. Now, applicable large employers are responsible for filing tax forms with the IRS, and they're also responsible for offering coverage. So let's go through that once again. They have the two obligations: an applicable large employer with 50 or more full-time, including equivalent employees, full-time equivalents. They must offer coverage to 95% of their full-time employees. Failure to do so results in that sledgehammer 4980HA penalty. And if they do that, they also have to make sure that it meets the minimum actuarial value and it is affordable. Otherwise, they hit that 4980HE penalty. But their other obligation, which is where we're going to spend our time today, is that they must report to the IRS the coverage they offered or did not offer to the employees if they are an applicable large employer, and they must furnish the forms to their full-time employees. And this is under 6055 and 6056. Now let's break it down a little bit. 6055 is one that causes a little bit of confusion. And basically it says that all providers of insurance must report who took the coverage under the health plan. This was for the individual mandate penalty. The individual mandate penalty is still alive and well. The only thing is that the penalty has been reduced to 0, and that was under the Tax Cut and Jobs Act. But President Biden has already given signals that he is going to put that penalty back into play. So even though we did not have a tax penalty, or the tax penalty was 0, the individual mandate is alive. So who is the provider of insurance? Well, if you have a fully insured plan, that is the carrier. And they are going to provide a 1095B to the employer, to the employee, and furnish with the IRS. Now, since 2019, they don't necessarily have to give the form to the employee as long as it's on the website, and as long as on the website, the employee knows where to go get it. But on a self-funded employer who has a self-funded plan, we did not get that opportunity not to furnish to the individual, and that is under Part 3 of the 1095C. The IRS said, hey, you know, if you're self-funded and you're reporting on the coverage that you offered, you're already doing it if you're an applicable large employer, so you do it under the 1095C. Now, 6056 is the obligation that all ALEs must report the coverage that they offered. Those are those lines 14, 15, and 16. And what do we hear a lot from applicable large employers who did not file? Well, we're fully insured, and we thought the carrier was going to file. And again, the carrier only files on those that took the coverage. The applicable large employer must report on who they offered coverage to, whether or not they took it. So what happens if you don't file or furnish? And you have to do it timely, and it has to go to all your full-time employees. The timely, you have to, you know, do the 1095Cs and the 1094Cs and timely file with the IRS. You have to ensure that the forms are accurate. If filing more than 250 forms with the IRS, that must be done via their air system. And if you are late filing, generally the penalty will be reduced to $50 per form if you get it done within 30 days. Generally, they will be reduced to $100 if filed by August the 1st. So those are other important dates to remember. And there is no good faith attached if you don't file. So in 2015, the penalty started with $250 per form. And in 2020, we are now at $280 per form. We don't know what it's going to be in 2021, but if they follow suit, it will be $290. Now, one of the things that you need to know of is, you know, whether your client might be waiting with a bated breath and thinking, I just have a few more years to wait out and the statute of limitations will apply. Please, please, please don't catch me now. Statute of limitations, you know, they think maybe 7 years. Wrong. Not with these filings for the Affordable Care Act. There is no statute of limitations. The IRS can come at you at any time, and you need to be aware of that. So, Casey, do we have a poll question?
Yes, we do. I'm going to go ahead and launch this poll here. Let's see. All right. Have you ever had a client who failed to file or furnish? We'd love to get your responses here during this poll. It also helps us figure out like what kind of information you guys would like to hear about more so in this webinar. So if you could just go ahead and let us know if you've ever had a client who failed to file or furnish their ACA reports. I'm going to give it just a few more seconds here, Michelle, and then we'll close the polls as we let a few more people get their votes in here. All right, it seems like we have about half of the people who have turned in their votes. I'm going to go ahead and wrap this up and close the poll. And let's see if we can't share the results here, Michelle. So it seems like we have 43% that said yes, which is a little bit surprising for me. And thank goodness we have 57% with no. What are your thoughts on that, Michelle?
Exactly. What we're finding is more and more employers just did not know they had to file, especially those who might have just become an applicable large employer. Maybe in 2015 they weren't, and then they never went back to check each year to see if they were. And I think we have another poll question, don't we, Casey?
We do. We have our poll number 2. I'll go ahead and get that up on the screen. Do you check with current and potential clients each year if they have a plan for ACA filing? So you as our broker partners, are you following up with your current clients or using ACA filing as a potential prospecting tool with new clients? Give you guys a few seconds to get your answers in here. And we just also want to let you know, if you have thoughts on our ACA presentations, if you have questions or maybe topics that we haven't covered that you would like to learn more about, feel free to reach out to me or Michelle Barki or Tom Neal at Medcom Benefit Solutions and suggest any topics for these webinars. We are always open. And the point is to bring you information that you need the most. So we are very open to your feedback and would love to hear your suggestions. All right, so thank you for sending in your answers for that poll. And here are the results. 80% yes and 20% no. Michelle?
Well, that's wonderful that 80% of you do this. And, you know, every year you should be checking with your, especially the ones that are on the border of being an applicable large employer or not, and making sure that they are or are not, making sure you have options in place for them. And again, if you're a broker and that you're not as familiar with the ACA as you might want to be, potentially because you dealt with a smaller group market and now you're getting into a bigger group market, it's very important that you get up to speed and attend Medcom's webinars because we always try to get you up to speed. But it's very important that you check in each year with your clients and make sure that they are following through with their ACA. You will be surprised how many times we have seen, and I just got one this week where they filed 15, 16, 17, and all of a sudden 18 they failed to file. They thought they had something in place and they didn't. And the penalties can be pretty significant. So what if you don't file? Well, you are going to get a love letter from the IRS. And the IRS is going to say, hey, we believe you're an applicable large employer. We believe you did not file. And no longer do we see that nice little letter they used to send, like, were you an applicable large employer and can you file within the next 90 days? No, no more of that. Now they're getting tough. Now they just send you the love letter and they said, we think you're an ALE. We don't think you filed. And this is what we propose the penalty to be. And when they propose the penalties, they propose it based on the W-2s. Now, you know as well as I do, you send a W-2 to somebody who's even just worked one day and doesn't even make your waiting period. So when you're talking about those W-2s that they're basing the penalties off of, the penalties could be substantially more than you owe. But at this stage of the game, the IRS is on the offensive and the employer is playing defense because now they've got to get back to the IRS. And the proposed penalty, let's just say for 200, if you have 200 W-2s out there, what would the proposed penalty be in 2020? Well, for failure to file, it would be $56,280 because you always take 201 forms because you also have to file the 1094C form. And then failure to furnish to the individual taxpayer, to your employee, would be $56,000. So the total for 200 W-2s would be $112,280. Now imagine if you had 500 W-2s, what that would be. Or if you had 1,000 W-2s, what that would be. But the first line of defense, whenever you get one of these love letters for failure to file and failure to furnish, is you got to go back and you've got to identify who your full-time employees were and who needed a form, and hopefully reduce that number accordingly. But the second line of defense is reasonable cause. You always have the opportunity to go to the IRS and say, there was a reason I didn't file. But reasonable cause is a very hard sell. So once you get the numbers down and say, hey, I don't owe 112,000, I only owe 90,000. How do we get that, the IRS to forgive that 90,000? It's not easy. If the employer wants to ask for forgiveness on failure to file, it's a reasonable cause determination. And the general rule for reasonable cause is one of two reasons. There are significant mitigating factors with respect to the failure to file or furnish, and the failure arose from events beyond the filer's control. Typically, we are seeing that the mitigating factors that we're using in these reasonable cause determinations is the first one, significant mitigating factors with respect to the failure. And basically what the significant mitigating factors we're trying to use is, gee, we didn't know we were supposed to file, or gee, we just changed brokers and the new broker told us we should have filed and we didn't, or along that line. And it can be a pretty tough sell. So we really need to make sure that our employers are filing appropriately and timing. The IRS was a little forgiving in 2015 and 2016. They are not so forgiving 17, 18, 19, and onwards. Now, there's also a reasonable manner that the filer exercised reasonable care, which is the standard of care that a reasonably prudent person would do under the circumstances, and that the filer undertook significant steps to avoid or mitigate the failure, including where applicable. They requested extensions, they attempted to prevent an impediment of failure if it was foreseeable, they acted to remove an impediment, or they rectified the failure as soon as possible once the impediment was removed or the failure was discovered. Well, there are forms you need to file if you are going to file an extension. We don't see that happening. So now what we're seeing is, again, throwing ourselves on the mercy of the IRS and saying, once we found out that we didn't file because you told us, now we're going to act in a reasonable manner. So what is the reasonable manner that the employer has to do now that the IRS has brought it to their attention that they haven't filed? Well, that they took the letter seriously that they got from the IRS. Nothing I hate more than getting a third letter down the road because the first two letters that they got, they didn't pay attention to. And now all of a sudden they've got a threat of garnishment, and that's when they take it seriously. We've got to take it seriously at the first level. That we are trying to get the filings to date. So now they have to go back and do all their past filings to make sure that the IRS understood that, yes, we did take it seriously, and yes, we're going to bring it to date. Doesn't mean they're not going to get more penalties for failure to file and furnish, but it doesn't negate the idea that they have to bring it to date. And they might also take additional steps. Maybe they hired a new person to take charge. Maybe they had a change in HR. But we've always got to make sure that once we get that letter, the first letter, that it's taken very seriously and they're trying to rectify where they went wrong. And the third thing we have to look at is significant mitigating factors. And the fact that, and what the government is going to look at is, one of the reasons we use is the fact that prior to the failure, the filer was never required to furnish the statement. So if they haven't filed in 15 and 16 and the IRS kind of ignored them, and then in 17 they got the letter, well, you know, we have to go back and say, hey, we just didn't know. And now that it's been brought to our attention, we're doing everything we can to get all the past filings to date, 15, 16, and 17. It also helps that they offered coverage to their employees, and the coverage meant minimum actuarial value and was affordable, because then you could tell the IRS on top of it, look, we did everything we could comply as an applicable large employer. We just didn't realize about this reporting requirement, and there would have been no penalties owing because we did what we were supposed to and we have no reason to hide. So there's different things that we try to argue. The IRS at that stage of the game is also going to look at the employer themselves and see what their filing history has been like. Have they always filed all their other forms besides the 1094 and 1095 timely? Have they ever incurred any other penalties down the road? And once they got a penalty, if they had down the road, what did they do to decrease the error rate? So they're going to look at the whole history of the employer as well. So again, it's much easier to file the 1094s and 1095s timely than it is to try to make it all better at the end. And again, the IRS is getting very, very tough. So then the other things are, that you can use as excuses are things that are beyond the filer's control. These don't typically fly because we haven't seen very many of them. Some of them are the unavailability of business records. So like, yeah, they might have merged with another company and they said, well, we don't have our old business records. There was undue hardships. Maybe they tried to go to the IRS and they got bad information. Or, you know, maybe they just didn't get enough information so that from their payroll company so that they can do it. I will tell you, we haven't seen much of this. Usually what it is failure to file simply because they didn't know they had filing obligations, or if they did in the back of their minds, they were overwhelmed and didn't know how to do it. But that's not beyond the filer's control. If it is, we have a good case. Unavailability of business records. Again, why don't they have the business records? Well, was there a fire? Did they not have any backup tapes? Were they hacked? Things like that could also help a case. But again, we're not seeing too much of that. Undue hardships, filing electronically because of the requirements that 250 forms or more you have to file electronically. It can be expensive, and they would have to be able to show that there was an expense. They have to go and show that they got 2 quotes, and they did all sorts of things to show that there was an economic hardship. You get one bite of the apple. Once you can go and file a form and say, hey, I can't file it electronically, it's too expensive, and therefore I'm going to file everything manually. Typically, the IRS will accept it the first time if you're making an effort the second year to get it filed. But that second year, boy, you have to have it filed electronically or you're in trouble. And then always, whenever we are doing any kind of backtracking with the individual, the filer must show that there was actions of the IRS, that the failure was due to the IRS. You have to show in writing that the IRS said something to you that led you to believe that you didn't have to file. But that information has to come from the IRS in writing. And good luck with that, because the IRS is pretty together and they don't make too many mistakes, that they would give you something in writing that said, you're forgiven. So again, make sure that you know, you get the filings done and get them done on time. You know, you can also blame sometimes another person. It's never a good idea to try it, but sometimes you can. And that the failure resulted in the failure of the payee, another person required to provide the information necessary to the filer. Again, this would be blaming the payroll company, saying, hey, I tried to do the filing, my payroll company wasn't going to do it. I tried to get the information from my payroll company, and lo and behold, they didn't give it to me. Or it could be that the failure resulted from incorrect information, and I was going back and I was trying to get the correct information. And then the first question the IRS is going to say is, did you file for an extension? So again, every time you have, and you're blaming someone else, actions of the other person, the payroll company, you better make sure that you've got an audit trail going that way as well, and that you can provide the supporting documentation to the IRS. So far, Medcom has saved over $50 million in projected penalties to date. I'm telling you, the ones for failure to file and failure to furnish are getting very, very tough. And when you look at everything that goes into an appeal on failure to file and failure to furnish, first off, you have to make sure that you do all your back filings. Second off, you have to look at how many full-time employees you had as and not just how many W-2s were sent. That's the first savings. And third, when you look at everything we talked about today, you have to have a reasonable cost determination. You have to then go down and indicate that you acted in a responsible manner. You have to go and make sure that all your other taxes have always been done great and that you've been very compliant with everything else. or you have to go into you're blaming somebody else, or you just couldn't get your records. These determinations take a lot of work to get done, and they're not always successful. As a matter of, and they're not usually successful, but they're a lot of work. So it's much easier to make sure your clients do the right thing, do their filings on time. If they can't get them done on time, try to get it done within the first 30 days when the penalties are substantially lower, or if not, by August the 1st, when the penalty is still only $100 and not as much as it is for regular. But we cannot let our clients bury their heads in the sand, and we always must make sure that these filings get done and that they get done timely. So every year you should be doing an ACA checkup with your employees, with your employers, and making sure that they have a game plan in place. If you've got an employer that's borderline whether or not they're an applicable large employer, make sure, determine that whether or not they do have the filing requirements. It's very, very important. Failure to file, failure to furnish, huge penalties. Just got one in today for over $2 million, big client. So again, we need to make sure. So with that, Casey, do you want to talk about some of our ACA solutions at MedCom?
Absolutely. And just as Michelle mentioned, those penalty appeals that we see coming in even more and more now that the IRS is back in business and trying to catch up with their penalties. That is part of what we offer. We do penalty appeal support, but we also have other offerings through our ACA Solutions, which includes the ACA employer reporting that we're talking about now, the ACA FTE tracking, the back filing. If you missed some years and you need to do back filing, that's something that MedCom can help with, as well as the consulting and strategic evaluations. MedCom's ACA department, they've been here since the inception of ACA, since MedCom started offering this so many years ago when the ACA was started up. We've had the same team, and we've just grown and grown over the years, and they are knowledgeable. They are a team of experts, and they are dedicated account managers to you and your employers, and they are here to help them through these steps. So a few of the other things that we offer here at MedCom are CDHP COBRA Premium Billing Administration. We also have HIPAA Privacy and Security Solutions, as well as your health and welfare compliance and actuarial solutions. So we're a little bit of a one-stop shop for all of your benefit needs, just in case you didn't know of some of the things that we offer. At this time, if you guys have any questions on the materials that Michelle covered today about failure to file, failure to furnish, deadlines, penalties, things like that, please go ahead and submit those now to the questions panel, and we can go ahead and address those while we're on the call today. So Michelle, we do have a question here. What if you did not file or furnish in 2016 and decide to do it now, but you never got a letter? We can't hear you, Michelle.
That is a really, really good question. Yes. I would still go ahead and I would do the back filings. And the reason being is the government can go back anytime and say, hey, you didn't file or furnish. At least now you're making a good faith effort. Doesn't mean that they won't come back to you and say you owe this penalty, but you still have a better chance of negotiating it at that time than if you just ignored it. So again, we never want to say that you're going to get away from that penalty in 2016 if you file it now, but you've got a better chance than when the IRS catches up. And believe me, they're going back. We've seen some coming in for 15 and 16 now on ESRPs when they did not, live up to the employer mandate. No statute of limitations. Just remember, they can come back forever. And we've got a new administration that really wants to start collecting some money because we've spent a lot of money and they want to make the Affordable Care Act work. And the third reason is last year in June, the Treasury Inspector General for the Taxpayer Advocate wrote a scathing letter to Congress about the failures of the IRS to collect penalty dollars. So the IRS is on notice that they have to. So again, I always say go back and do it if they were an applicable large employer in 16.
We have another excellent question here, Michelle. Are there penalties for not addressing errors from filings?
Yes, the penalties for not addressing the errors can be the same as they are for making a mistake. We haven't seen so many of those right now because of the fact that you know, we do have good faith years. However, in that Treasury Inspector General report, one of the things that they brought up is, you know, we're seeing a lot of penalties being mitigated on and the employer's shared responsibility because of bad coding. And they did bring up to the IRS, when are you going to define what good faith is? And when are you going to start penalizing because they did not file correctly? So I imagine we will start seeing that. We just haven't seen it yet.
So what happens, or what should the first steps be for an employer that receives one of these quote unquote love letters? What should they do?
The first step they should do is get with the broker. And then, you know, you need to get some help in getting these resolved unless they want to do it themselves. But as you see, it's a complicated process. You don't want to ignore it. You want to get going on it right away, because one of the things that helps is the way you acted after you got the letter. And, you know, don't think the IRS is going to go away, because they are not. So I would always mention to your client that the first thing they need to do is contact you if they get one of these love letters.
So back to the errors from filings. If a person has a lot of Social Security number / name mismatches year after year, they've kept their records of requesting twice a year. Do they have to do that every year if they're the same mismatching errors?
You know, that is an excellent question. That came up the first year of ACA reporting. And basically, the IRS has said every year you have to make sure that you ask your employees whether or not they've had any changes to their social and that this is the correct social. So yes, do that. It can be done at open enrollment. Just make sure that that gets done so that you can say yes. And then those mismatches are going to be there. The IRS got out of whack really early on with some social numbers. And that was brought to light for sure when we were doing these mixed matches. And the IRS has even said that the cure to this is checking with your employees to make sure that this is their number. You'll continue to get the mismatch. The first year we said, hey, what about if we go to the Social Security Administration and get the number from the Social Security Administration? And the IRS said, you don't need to do that because we know we're out of sync with Social Security and that we probably have bad socials. But those mismatches are happening all the time. And the cure to that is just making sure with your employees and their dependents that they do match, you know, what they have on their records. We're not seeing it so much on the employee side, but on the dependent side in self-funded groups, but we do see it all around.
Absolutely. Well, thank you, Michelle, and thank you for everyone who attended today and for submitting your questions. If you have any last minute questions, go ahead and put them in the chat feature or the questions panel, and we will address them here. But I do want to say thank you to Michelle Barki for sharing your expertise today. If anyone on this call needs more information about what MedCom provides as far as ACA Solutions, please reach out to Tom Neal. Tom couldn't be with us today, but he is definitely here in spirit. You can reach out to him via email at tneal@medcombenefits.com. So we don't have any other questions that have come in. Michelle, thank you again for being with us today. And thank you to all of the attendees for giving us your time and the opportunity to speak with you. We hope you have a wonderful rest of the week.
Thank you, Casey.
Thank you.